Hey, and welcome back to a new video. Today I want to talk about one little concept of reversal trading that you will see around many reversals that happen. It's called a bull or bear squeeze, or you can call it bull or bear trap. It all describes the same set of principles, and I will show you what it is. So first of all, let's see, this is the crude oil daily chart. And you can see that price went from a downtrend to uptrend, and this was the transitioning period. And I want to show you why this was such a great type of reversal trade and what the psychology behind that is. So first of all, we can see we went here down for quite some time. Price went from 50 to almost 24. So it was a 50% cut in price, and then you can see that price made this swing point here. We made a new low, a lower high, you can see here, and then price made another run. You can see even that once price moved into the previous lows here, that the candles got larger, the selling got stronger, and then you can even see when we zoom in a little bit that price gapped down a little bit here, and then we broke this the lows here. And to everybody involved, if you don't know what has happened here, it looked like price was going to even 20 or lower. So everybody was joining this downtrend here. But the next day, what you can see, price closed here. And then the next day, price closed up here. We gapped higher. And then this day was a very large green bar where all the people who were short position got squeezed a lot. They had to exit and abandon their trades. And then obviously what followed was this long rally. And since we were reversal trading, we were not looking to join this short trend here. So we were not interested to sell here on the break. We were only interested to buying, but we were not buying on this move lower, because our rule of thumb is that we only buy once price breaks this 20 period moving average. So you can see that we had this bear trap here. People were tricked in entering short positions, and then immediately the professionals reversed price and squeezed everybody out of their shorts. And then afterwards price started this nice rally back to the 50s now. So although we did not enter until price broke the moving average here, this squeeze here gave us a lot of confluence and a lot of context to our long trade. And this is something that you can see across many reversal trades, as we will see now. So for example, here we had the euro dollar Canadian. It's the 4-hour chart, and you can see something like a short-term uptrend with multiple trend waves, 1, 2, and here this is a very short trend wave that is more like a market top. But you can see that if we draw a trend line here around the highs, you can see that there was some type of resistance, and then price here broke the resistance. At that time, you don't know what has happened here, so this would probably look like a new trend wave, and people would enter their long positions because they think finally price is able to break the highs here, and they entered their longs. But then what happened in the same candle, price was rejected very hard. This is even an outside bar. You can see that the high and the low completely engulfs this little green bar. So this is either you call it a green outside bar or engulfing candle, which is a strong reversal signal. And again, people who entered short prematurely, they got squeezed here. They got squeezed out of their long positions and had to exit their trades. And this, of course, if people buy here and enter a long trade, and then they have to exit their trade, this is a sell trade, which then reinforces this movement here to the downside. And then when we look into the opposite direction, you can see the same exact pattern. You can see 1, 2, and then the final is a very short. Let me correct that. The second trend wave, and then the final one is very short. But here at the bottom, you can already see that we have this massive spike to the downside, A lot of people would probably enter here short as they think the trend is accelerating and gaining momentum, but then obviously it reversed in the opposite direction. It squeezed everybody who was short here. Everybody who was short had to exit their trades, and when you exit a short position, you have to buy back. And so this people who got out of their short positions then also influenced and started this long trend. And again, when we're on the other side, you can see price made multiple trend waves here. Then here we had this swing high, and then on the next trend wave, you can see multiple attempts to break the highs. 1, 2, 3, 4 candles to the upside and wicks to the upside. And then what happened when the buyers run out of steam, then the sellers take over and drive price down, and then everything starts over again. And this pattern you can see over and over again on all time frames, all markets. It is not so much about the pattern itself, and it's not about 3 waves and then this squeeze here. It's about the psychology that is behind this type of market behavior when you see that price is trying to break an important level, because at that time you don't know what is happening afterwards. When you see something happen like this in real time, it looks like the price is accelerating and everybody's excited and want to join the trend and write their trades more. And then what happens, it's very easy to catch the people on the wrong foot. When the professionals reverse price, everybody who entered their long positions along the way is then forced to exit to protect their profits, and then this helps to accelerate the trend to the downside. So this is something that is worth paying attention to. It is not a blueprint pattern like so many amateur traders are looking for. This is how you read market and price structure and find out how traders are forced into and out of their trades.